Let's take a look at this constant growth valuation problem. You are considering an investment in the common stock of Crisp's Cookware. The stock is expected to pay a dividend of $2 a share at the end of the year. The stock has a beta equal to 0.9. The risk-free rate is 5.6% and the market risk premium is 6%. The stock's dividend is expected to grow at some constant rate given by the variable G for growth. The stock currently sells for $25 a share. Assuming the market is in equilibrium, what does the market believe will be the stock price at the end of 3 years? In other words, solve for P hat sub 3. All right, let's bring in a formula that will help us here. Okay, this is the required rate of return on the stock, and it's calculated by adding the risk premium for the market times beta plus the risk-free rate, right? So R sub M minus R sub RF stands for the risk premium. All right, so let's fill in what we know. And I worked this ahead of time, so I'll just bring these colors to light here. So the dividend for next year is $2. The beta is given as 0.9. The risk-free rate they gave us is 5.6%. And the risk premium for the market is given as 6%, and that's called the market risk premium. I got to say that correctly. So the market risk premium is given by the rate of return required for the overall market minus the risk-free rate. Okay, the current price of the stock is selling at, what's that? $25. I think they gave us that. And we need to solve for R sub S. And the way we can solve for R sub S is using this formula here. So we're going to take the value in E12, which is the risk-free rate, plus the risk premium times beta. So we're just working this formula right here. And when we do that, we're able to determine the required rate of return, and it's equal to 11%. The next item we need to solve for is the expected rate of return on the stock, and that's given by this formula. So we take the next dividend divided by the current price plus growth, and that's what the expected rate of return on the stock is. Now, we have all that information, right? The expected, if we're in equilibrium, the expected rate of return is equal to the required rate of return. So we just jot in this formula because we're going to solve for G. That's what we need to know. And when we do that, we basically say G would be equal to the 11%, the required rate of return, minus the 3% growth. So hopefully you see it. I know R hat sub S. I know D1 and D sub 1 in the current price, P sub 0, and then we're solving for growth. So we get 3%. Now, once we have that, we can solve for the dividend. And the way we can solve for the dividend is simply a future value formula, right? Take the current price, multiply it times 1 plus the growth rate, that's the interest rate, and raise it to the power of 3. That's simply a future value. And in fact, I'll solve the future value right here. So you see the formula. I'll hit F2. You can see it down here. I'll call it up. So the rate is 3%. Number of periods is 3. And there's no payment. We'll give the present value as a negative number so that we get an answer with a positive number. And we come up with $2.19. So either of those approaches, either the formula or the future value formula, a finance function built into Excel, will get you the dividend we're expecting at the end of year 4. And then we need to solve for the expected price at the end of year 3. And the way we do that is we bring in the formula that you would solve for the expected rate of return right now, and we just have to use the values that we have that we've calculated for the dividends at D4. So let me show you how we solve that. We take E20, which is the dividend of $2.19 we just calculated, and we divide it by the required rate of return, which is the 11% we solved here, minus the growth. So we're just doing this portion of the formula here. And the growth was 3% given in E19. Now, a long way to do that, or another way you could do that, is just lay out the cash flows, right? So if we lay out cash flows of $2 and then increase it by 3%, which is multiplying by 3%, we come up with that same dividend of $2.19, and then of course we can solve using that same formula approach, right? So this is just another way to get to the dividend at the end of period 4. And I've bolded the answer. The answer is $27.32. And that's this problem, everyone.